Economic uncertainty is fueling volatility on Wall Street, and that has many wondering how to navigate the wild swings. Joining me now, we've got Jesse Nino, who is the Edward Jones financial advisor. Jesse, great to have you here with us. You say it's important to prepare for market downturns, both financially and emotionally here, and my mood ring certainly is on the constant adjustment here. So walk us through that.
Yeah, thanks, Brad. Thanks for having me. So when we're working with clients today, there's two really main themes that we're talking with them about: preparing ourselves emotionally and also preparing ourselves and our portfolios financially. So when we think about preparing ourselves emotionally, one of the biggest things that we can remember right now is that regardless of what's causing this volatility, we know that we experience about a 30% drop in the market every 3 to 5 years. And we haven't had one since March of 2020. So that's 5 years, meaning that it's just best to prepare ourselves that this volatility may continue. And the second thing we try to remind our clients of to prepare them emotionally is that, every single time we have a down market, it is followed by an up market, and those up markets are typically longer and stronger. And then lastly, just looking at the most recent volatility, we did hit a 10% drop in the market. We know that on average, we have about 2 5% drops a year and 1 10% drop, and that's still considered perfectly normal volatility.
And so with all of that in mind, how can investors smartly take advantage of some of the downturns that we see in the pullbacks?
Yeah. So there's a couple things that investors can do to take advantage of these pullbacks. Number one is this volatility inevitably creates some imbalance in your portfolio. So just great opportunity to look over the diversification, reassess your comfort level with risk, your time horizon, and your spending needs. The other thing we can do to take advantage of this portfolio is consider some tactical moves like boosting your contributions to your 401k, your HSA, or this might be a great time to consider some of those Roth conversions while those share prices are down. And then lastly, just hoarding cash, as we say, or putting some hay in the barn. We like to have extra cash on the side to prepare for any unknowns or also take advantage of some of those share prices being down.
So with that in mind, if you have a retirement that is perhaps a week, 2 weeks away, or maybe you're in retirement right now, my goodness, and you're drawing upon some of this cash that you've saved up or these positions that you've saved up and continue to accrue upon, what is your down market strategy?
Yeah. It's really important that every investor have a down market strategy, but even more important when you're drawing that income. So number one, best thing to do if you're starting to feel panicky is just pause and make sure you're engaging with a professional financial advisor before you make any major changes to your portfolio. The second thing that you can think about doing is shifting the source from which you take your income every month. So maybe you're shifting your income to come from cash reserves, or even dividends and interest during this time, or perhaps you're starting to sell some of those bonds or bond funds that generally hold their value better when the stock market's down. The last thing we'd say it's important to do is just double check that reliance rate, making sure that you're not drawing too much out of the portfolio so that the portfolio can make a full recovery when the market returns.
Jesse, thanks so much for taking the time here with us today.